Imagine two people walking into the same dealership on the same afternoon, choosing the same model, the same color, and even the same options, yet leaving with loan agreements that will cost them thousands of dollars apart over the life of the loan. At first glance, it feels unfair because the car itself has not changed, the manufacturer has not changed, and the dealership has not changed. Yet one buyer pays significantly more simply because of a number that exists almost entirely as a financial reputation. That number is a credit score, and while most people understand that it affects borrowing, far fewer understand how dramatically it changes the true price of owning a vehicle. The sticker price may be identical, but the total cost often is not, and the difference has less to do with the car than with how lenders measure risk. The common assumption is that a credit score acts like a pass or fail test, where a high score earns approval and a low score leads to rejection. In reality, the system is far more gradual than that. A lender rarely asks whether someone deserves a loan at all. Instead, it asks how much uncertainty exists and how much extra interest should be charged to compensate for that uncertainty. Every point on the credit scale influences the lender's estimate of risk, and that estimate becomes part of the loan's pricing. The car becomes the same product sold through different financial contracts, each carrying its own long-term cost. This creates an interesting psychological effect because most buyers focus on what they can comfortably pay each month rather than what they will ultimately spend. Dealership conversations often revolve around monthly payments, trade-ins, and down payments because these numbers feel immediate and manageable. The total interest paid over 6 or 7 years feels distant, almost invisible. Human decision-making naturally favors present affordability over future expense, making it easier to accept a loan that appears reasonable today even if it quietly becomes much more expensive over time. Consider a simplified example. Imagine one buyer qualifies for a low interest rate because they have consistently paid bills on time, maintained moderate credit utilization, and built a long history of responsible borrowing. Another buyer selects the exact same vehicle, but qualifies for a substantially higher rate because their credit history contains missed payments or limited borrowing experience. Even if both finance the same amount over the same number of months, the higher interest rate means a larger portion of every payment goes toward interest rather than reducing the loan balance. Over several years, those additional interest charges can accumulate into thousands of dollars. The vehicle never became more valuable, yet it became far more expensive. This is where the mathematics of compounding quietly enters the picture. Interest is not simply an extra fee attached to the purchase. It changes how each payment is divided throughout the life of the loan. Early payments often contain a larger interest component, especially on longer loan terms. Extending financing from 4 or 5 years to 6 or 7 years may reduce the monthly payment, but it also increases the amount of time interest continues to accumulate. A lower monthly obligation can therefore create a higher overall cost, even though the payment itself appears more affordable. Credit scores also influence financial opportunities beyond the initial purchase. Someone paying less interest each month keeps more flexibility in their budget for savings, emergencies, education, or retirement contributions. Someone paying more interest may have less room to absorb unexpected expenses, making future borrowing more likely. Over time, these differences can reinforce themselves. Lower borrowing costs create more financial breathing room, while higher borrowing costs make it harder to improve financial stability. The gap is not created overnight but through many small financial decisions that build upon one another. In the past, this has been proven to show that access to affordable credit has long shaped economic opportunity. Whether financing homes, businesses, or vehicles, the cost of borrowing has often determined how quickly families accumulate assets or remain focused on debt repayment. Modern credit scoring simply automates part of that process by translating financial behavior into a numerical estimate of lending risk. While no scoring system is perfect, its influence on everyday purchases has become difficult to ignore because borrowing is deeply woven into the modern economy. Perhaps the most useful way to think about a credit score is not as a judgment of personal worth, but as a financial signal interpreted by lenders. It reflects patterns of repayment rather than character, and unlike the price printed on a window sticker, It is something that can gradually change over time through consistent financial habits. Paying obligations on schedule, keeping debt manageable relative to available credit, and avoiding unnecessary borrowing can slowly improve that signal, leading to lower borrowing costs in the future. The next time two identical cars sit side by side on a dealership lot, it is worth remembering that they may never truly cost the same. The difference is often invisible, hidden not in the vehicle itself but in the financial system surrounding it. Understanding that system does not guarantee cheaper transportation, but it does make the numbers easier to see, and once those numbers become visible, financial decisions become less about appearances and more about long-term cost.